Alright, I want to go over a strategy that I learned from Greg Michalowski. He's Fxdd Vice President and Chief Currency and Trading Analyst. He also has a book out called Attacking Currency Trends. You can find the book at attackingcurrencytrends.com. The strategy is using moving averages. It's using two moving averages. I'm going to be using a 100 bar moving average and a 200 bar moving average. I'm using simple moving averages. The blue is my 100 and the green is my 200. Basically, if price is above your 100, it's showing you that the market is bullish, the bullish bias. And if it's below, it's showing you that you got a bearish bias. And your 200 confirms that it's bullish or bias. So what we do here, we're looking at this trend here. We've been up in an uptrend for a little while, and now price breaks this 100 bar moving average. We want to put a trade in to go short. Okay, your risk is going to be a little above your 100 bar moving average, but the way I really trade it myself, I go to your next level of support and resistance, which is, if you look right at the 100 bar moving average, that was where the level of support and resistance was. So as you can see, the 100 bar moving average holds weight when it comes to holding support and resistance. But I would move up to my next level of support and resistance, and you find that level right here. So I will put my stop in right there. Now it all depends what you can risk to put in, for your money management. But right here you're risking, this is a 55 pip risk. And if that's too much for you, you just have to decide if you should even get in a trade or where your risk should be. You could put your stop, like we say, about 10 pips, 10, 20 pips above the 100, and then you know that if it comes back against you that you were wrong. So basically, if you were wrong, you get out. The market's not doing what you expected it to do, so you get out of the trade. Okay, but we're looking here. We break this 100 bar moving average, and when we broke the 100 bar moving average, that was our trigger. We got in, we put our stop loss in, and then basically we hit this 200, and we tested that 200, bounced off it, tested it again, bounced down, tested it again, broke it a little bit, and then finally took off. The way I would play this trade out, if I missed this move here and I wasn't able to get in, I see that we broke this 100 bar moving average. So yeah, I want to be in the trade long. So what I do is I look at your fib levels. I try to get back in on a pullback. And if you're looking at your fib levels, you'll see that you put your fib in here, and then you'll see that this bounced right off of the 38.2 retracement level, came down, retraced at 38.2, and that's where I would get in. You got to look at your candlesticks or something to give you an idea, and that 38.2 is almost basically right where the 200-hour moving average is, 200 bar moving average. So I would put my stop a little bit above this. I would put it actually at the next retracement level, which would be my 50, or else you could put it above your 100. Your 100's another level of support. Okay, you see it came down. What it hit? 38.2. That's the level that I really look at to get back in. 38.2, bounce back down. Now sometimes markets don't always hit 38.2, so I'm not telling you that. You can look at an area though. You're looking at areas where there can be something happening. I call it like decision making areas. So this is an area, this is an area, this is an area right here, 61.8, 50%. These are areas that you're looking at something to happen in the market. And if it doesn't happen, then again your analysis is wrong. So you have to get out. But I'm gonna remove this fib and show you. Now if you got out, you didn't get in. If you didn't get in, look at this again. Here's what happens. You go to that swing high again and this swing low. Where's the market go to? 38.2, just a little bit above 38.2. Once again, you could get back in the market. You put a stop loss a little bit above this 50% level because your first level that it returned at was 38.2. So your stop's up here. What are you risking on that? You're risking about 27 pips. Not too much. Okay, so you bounced off of here and you came down. You're following this 100 bar moving average. Let's get rid of that. Okay, you followed that 100 bar moving average. You followed that 100 bar moving average down. There was no need for you to get out of the trade until you saw something changing. What changed? Well, we hit the 100 bar moving average and here we broke it. So maybe we got nervous and got out of the trade, but the trade still continued down for a little bit more. But you're good here. You're out. You see, this is like a support level. You see the market started ranging and getting into a little range a little bit. So here's your levels right here. Looked like the market started doing a little rangy motion. So yeah, you got out. If you got out, you come back to this area here and you look and you'll see we're back up to that 100 bar moving average. Now here's something that I learned from Greg. Inside here, you're trading in between the goalposts, he calls this, because you're between these two post like area, which would be your 100 bar and your 200 bar. So when you're in here together, two's company, three's a crowd. Somebody's got to go. The two moving averages are friends, and price is not a friend of the moving averages, so price is out of there. Price takes off, price is gone. It breaks this. Here's our trigger. We get in, and here's our confirmation. We broke the 200, and there was a big move here. Some news or something happened here, so that made that move even bigger. And then the market tried to correct itself, came back here. Now you see you're sitting on this 100 bar moving average. You tested this, boom, 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 couple tests, boom, boom. So there's no need for you to worry about this trade right now or get in. This is confirming to you that this is strong level of support right here, right where this moving average is, because it's bouncing off it and it can't break it. Okay, and if you put your support and resistance lines in, you can see once again right here that level lines right up with this 200, with this 100 bar moving average. Basically you got support and resistance in that area. So yeah, that's how I look at the market, and that's how I trade the moving average based on the way that Greg has described it. You can learn more by going to their site, and there's webinars there where he talks about it, and in his book he really talks about it a lot. So you won't find this anywhere else but in his book about trading between the goalposts. And I'm not able to explain it as well as him, and but I trade it because I learned it and back tested it and followed him for a while. Let's go to another chart and just look at it real quick. Okay, you see right here, same thing. This is a rangy motion. The moving averages are tight together, twisting with each other. So it's not really a good time to trade, but you're looking for an opportunity, because when you see the market like this, what you want to look for is something to happen. You're anticipating a trend. So the moving averages started moving apart a little bit. So now if you would have taken this right here, you would have got stopped out. But you're putting in 10 pip moves. You take this again, it comes down here. You could have probably got out right here and got a small profit, or else you got stopped out. Okay, then the market came back, tested your 100, and then it came back up, and then it tested your 100 and broke it. Now if you look again in that range, here's your support area. There's that range area right there, and that's your support and resistance area right here. Okay, now once that level broke this 100 right here, what we do is we put our order in to get long, to get short, and we put our stop. I would put my stop above this support and resistance area, but if it's too much for you, put it above this first bar here. And if still you can't do that, then maybe you shouldn't be in the trade again. But as I say, you could put a 10 pip stop, and then look here, you break the 100 and then you break the 200. It tests the 200 for a little while. After it tests that 200, it broke it, went on down, and then the market ranged for a little while, hit the 100 bar moving average. It was another chance for you to get short again, and went down, came back around, tested the 100 again, another chance for you to get short again, boom. And then here we go, hits the 200 again, boom. These were all reasons for you to stay in the trade. No reason to get out of the trade. It didn't break the 100. So you want to get out if it breaks the 100, and you did get out. And then down we come here again. We're in the in that goalpost area again. So you know something's going to happen. So you look for something to happen. Okay, but I don't have time to really explain everything the way that Greg would, but you can go there and find webinars and learn all about the strategy, and I like using it. It's real simple and real to the point. So okay, thanks a lot. God bless.